there's one summary which is important, which everything we have done in this course, everything, has been based on the concept of probability and what things might happen. This is what has allowed us to be able to measure things. Okay, so probability has been at the bottom of all the measurement activities that we have done. And when it comes to probability, what we started to do 2 weeks ago is to use the probability tools to generate the future. In investments, you can look at the past, but things that happened in the past are not going to be the ones that will give you performance or risk in the future. Of course, the future, we make the assumption the future is similar to the past, but that was not always the case. And what we discussed in this last topic is how to generate future histories, maybe what happened in the past can help us generate things that will happen in the future. Okay, so the key was in the future, and we went through examples of what we call risk factors and how they impact our investment activity. We use the first example that came up in the course, how in this case we used scenarios to make a model for how our investment activity would work. Okay, and what we saw that in this case, doing scenario analysis, we could come up with a way to understand our investments. In this case, this led us to see that this investment was bad. Then we had ways to fix in this investment. So all of this was based on scenario, things that project what will happen in the future. Then we saw probabilistic and statistical ways of addressing those issues. We saw ways of graphing the results that we get from analyzing history. We saw the relevance of non-Gaussian distributions and how they affect the analysis that we do. So all of these things that we have done were based on the concept of what may happen in the future. What happens in the past may be a reflection of what may happen in the future, but the future will be different. And we don't know how the future is going to be. Sometimes because of that, we do what's called sensitivity analysis, which is we see how a certain parameter changes and how that affects our investment. In this case, the parameter was the correlation. Okay. Then we saw how in the case, sometimes we make an assumption about a scenario, and there we do analysis, like in the case of trade financing. And then we saw the need to consider more than one scenario. If instead of this scenario you consider a different scenario, then your trade financing requirements will change. We also saw that. And then the question is, how do you do these scenarios? How can you do this better in the future? And we saw that there is essentially several ways of doing that, depending on how many scenarios we want to generate and how many risk factors we have. It makes a big difference if we have a single risk factor, like for example here or here, or when we have more than one risk factor, because dimensionality matters. In this case, we had two risk factors, the bond and the stock. In this case, we had three scenarios for two risk factors. This is very simple. Oftentimes, you are going to have millions of scenarios, even if you have only two risk factors. Okay. In this case, we did three. Why did we do three? We did three because this helped us understand everything we were doing. Okay. We could do everything explicitly, and I could show it to you in class, and I could have a spreadsheet like this that you can see. You have done this assignment, so you know that you can do this if you had more. So you can do this if you had more scenarios in front of you. So this is something that we saw. We also saw that there are large variation scenarios are very important. They give rise to stress testing. Okay, we saw that, and we saw that last week and the week before. We saw sometimes we do this not for probabilistic reasons. We just want to understand how bad things can get. Okay, so that was done, and the one-dimensional analysis is something that is relatively easy to do, and it all is based on this result that we saw, which is when we start with uniformly distributed samples, the inverse cumulative distribution function gives us samples generated according to a probability density given to us. And I remind you that the relationship between rho and the distribution is that the derivative of the distribution is the probability density. Okay, that's how we did that. So this is one-dimensional. In one-dimensional, this theorem works and is very useful. So we saw that. Then when we go to high dimensions, and today I will talk about high dimensions, things get more complicated. Okay, the probability distribution function is changed from the cumulative distribution in one variable to the cumulative distribution in all the variables, and the resulting function is not a curve, it's a surface or a hypersurface depending on the variables that you have. In the case of two variables, here when n equals 2, then your graph is in dimension 3. If you have 100 variables, then your graph will be in dimension 101. Very difficult to visualize, but still computers can help us do calculations and do things there. And that's what we're talking about today. The probability distribution function is the partial derivative of the cumulative distribution function with respect to all of the variables. So these are definitions. And oftentimes the risk factors that are involved are of different types. Stock prices, currency FX rates, interest rates. Okay, and the factors can be homogeneous or inhomogeneous. Homogeneous is when they're all similar. They all come from numbers, they all come from a similar distribution, or they are inhomogeneous, they come from different distributions. For example, when we saw the probability that my counterparty would default and would have snow. So the snow precipitation and the counterparty defaulting, these are risk factors that we'll have to model differently, and bringing them together is difficult. But today we will see how this is done. Okay? But we're going to start with the Gaussian distribution. The Gaussian distribution is the one which is easiest to understand, and we're going to be using that. The Gaussian distribution in several dimensions looks like this. It is the same distribution that we have seen rotated. But in this case, what makes a difference for this distribution is how elongated it is. And we saw that there is given any distribution, any multivariate distribution, there is a marginal structure, which is 1D, and then there is a dependent structure, which is multidimensional. Okay? Very good, that's what we saw. All of this can be quantified. And in the case of the Gaussian, the two-dimensional Gaussian distribution is given by a formula like this, where here rho is the correlation, as we say there, we see there. But in high dimensions, this formula is very neat, very nice, and easy to write if we use matrices and vectors. So if we use the vector of returns and the matrix of covariances, variances and covariances, then the density function is given by this expression. It's an exponential of the product of the dispersion with respect to the mean times the inverse of the variance covariance matrix divided by the determinant of the variance covariance matrix. So this is the Gaussian in multi-dimensions. I assume this is something that you already know. And when one is working with Gaussians in multi-dimensions, it's important to understand the structure of the variance covariance matrix. And the best way to understand matrices, especially symmetric matrices, is through their diagonal form. Okay? The diagonal form of a matrix is the one that we can always have when we reduce the matrix to its eigenvectors, eigenspaces. And it all rests on the observation that if our variance covariance matrix has zeros outside the diagonal, which is the same thing as saying that the marginal distribution are uncorrelated, then if we go to, I mean, you probably already know this, but if we go to the previous one, this expression here, if the variance covariance matrix has zeros outside of the diagonal, then this expression breaks down, and the Gaussian distribution is the product of the one-dimensional distribution. So this becomes one dimension. The uncorrelation creates a breakdown from multi-dimensions to one dimensions, one after the other. So this is a tremendous exercise in compression, because it makes something difficult very easy. Okay, this makes things very easy. All right, and you probably already know, with this, we saw that here, that every matrix which is symmetric has eigenvalues and eigenvectors. The definition of an eigenvalue and eigenvector is a vector that has this property. When you multiply the matrix times the vector, you get the same vector stretched in the same direction. Okay? So the same vector multiplied by a number. This is a number which is a real number, positive or negative, or zero. And one such example is this, but here I made a mistake. I remind you, I haven't fixed it. I have to fix it. So that's the mistake that I made. But this is the eigenvector, because when you take this matrix and multiply by this, when you go through the multiplication process, what you get is that this vector is invariant under this matrix. Okay? This is invariant. Again, the vector is this one. And what does that mean? That means that this matrix that we have here is actually, you know what it is, right? This matrix we have here is actually a rotation around the z-axis. So of course this vector is invariant. This matrix that we have here is a rotation matrix. And it rotates all vectors, but it leaves the z direction invariant. This is the z direction. Again, this is a mistake. Okay? This is one such example of a matrix and its eigenvalues and its eigenvectors. This matrix is not symmetric. Because of that, it only has one eigenvalue and eigenvector. The others are complex. When matrices are symmetric, they will have as many eigenvalues and eigenvectors as rows and columns. So in this case, they will have 3. But in this case, there's only 1. Okay, so this is linear algebra, things that I assume you have seen. Linear algebra is very, very useful because it allows us to work in spaces of high dimensions, and if you do it well, then you can bring down spaces of high dimensions into spaces of one dimension, which is very easy. Now, computers have a way of doing this, which does not require human understanding. The problem is that these things, even for computers, they take a long time. Okay? High dimensions are difficult things for computers to handle. Okay? So for that, it is going to be very important that we have some basis to base our analysis. And the result that I was mentioning earlier is this one. When I have a matrix which is square and symmetric of dimension n, and any number bigger than 1, then they're always going to be n. See, this n and this n are the same. There's always n eigenvalues and n eigenvectors. The eigenvectors are the ones that satisfy these equations. This is a number. This is a number. This is a vector. Okay. These vectors are such that their span is the entire real line. So the entire Euclidean space, all of it. Okay. The matrix is positive definite if and only if the eigenvectors are positive definite. And the matrix that I can come up with columns given by the eigenvectors themselves is orthogonal. Okay? Each eigenvector is orthogonal to each other eigenvector. So these are things that I assume. Sorry, I'm getting an incoming call. Okay, so I have to join again. Okay. Yeah, so sorry, I was getting an incoming call and that froze my display. I have to stop the share and reshare. Okay. All right. So these are results from linear algebra that I hope you saw. Today I'm going to build on them, but we're going to beyond. We're going to go beyond linear algebra into how this thing affects investments. Okay. One application that you may have seen in linear algebra is that through eigenvalues and eigenvectors you can perform operations on matrices. Like in this case, a matrix can be you can operate on the matrix by doing, for example, the square root. So the square root of a matrix is another matrix that can be described on its spectral projection by keeping the same matrix as it was and then taking the eigenvalues and taking the square root of the eigenvalues. Similarly, you can take the exponential of a matrix by taking the exponential of the eigenvalues and keeping the matrix form itself. Okay, so I remind you, when you have a matrix multiplied by a vector, this is the same as this. Okay, and this is the dot product. The dot product of the vector times the eigenvectors. So this is the matrix here. You have the eigenvalues here, and if you can take the square root, then the square root goes to the eigenvectors, and the exponential goes to the exponential of the eigenvectors. Okay, the eigenvalues. So this is how the matrix is transformed from one expression to another. Okay, so I'm going to use some analogies so that so I can explain to you how this can be used in financial markets. And the first analogy, actually the main analogy that I want to do is the one with music. And I don't know if you know this, but I'm going to tell you. Okay, because this example that we're doing here is very oftentimes done in infinite dimensions. And by the way, this is how MP3s are done. Do you know what an MP3 is? I think I asked you this question already. You know what an MP3 is? Do you play music on your smartphone, for example? Well, do you play music in any in any digital instrument? If you play music on any digital instrument, you're using a version of the MP3 technology. The MP3 technology, what it does is it takes a sound, which is analog, and it digitizes it. Okay, the digitization of a sound is done using the eigenvalues and eigenvectors of what? These are the eigenvalues and eigenvectors of this operator. It's called the wave operator because this is the operator that controls sound in life, in physical space. Okay. So this is like a matrix. What is a matrix? A matrix is something that sends vectors to vectors. So if you have something that sends functions to functions, it works just like a matrix. It's actually an infinite dimensional matrix. That's what it is. So we can use the same analogy as we had before and realize that when I have an infinite dimensional matrix, which is in this case represented by the wave operator, okay, then if this has eigenvectors and eigenvalues, these eigenvectors and eigenvalues are going to be very useful. So this is an eigenvector, also called eigenfunction, because we're in infinite dimensions, and that's the eigenvalue. Okay, and this will be eigenvectors and eigenvalues every time n is 0, 1, actually not 0, 0 no, 0 is not allowed. Okay, every time n is 1, 2, 3, so on and so forth. And if you know a little bit of, I don't know if you know a little bit of physics or you know a little bit of music or if you saw this in math, I don't know, but these same functions for the different values n, 1, 2, 3, they have this form. I'm gonna write it down here. Okay, so for example, for n equals 1, you get this one. This curve we have here, the first one, this is n equals 1. And this in music is called the fundamental frequency. And it's the one that you hear when you make a string vibrate, like in a piano and a guitar or a violin, for example. When n is equal to 2, you get this one. Okay? And this has a note here at the beginning, at the center. And if you know music, you will know that the note that these two strings produce are the same, just one octave higher. Okay. Then when n is equal to 2, you get a different one. You get this one. Okay, when n is equal to 2, you get this one. I didn't show very well. I'm going to show again. Okay, it's this one here. When n is equal to 2, this one here has two notes. It has two zeros. And in music, this corresponds to the dominant. I don't know if you know music and harmony, but if the first note is a C note, for example, then this will be a G note. And so on and so forth. Okay? And something which is interesting to point out is that in this context of infinite eigenvalues and eigenvectors, you don't need to store all of these when you digitize sound. When you digitize sound, in the process of digitizing sound, you introduce the concept of the bit rate that you must know, maybe not in English, but probably in Chinese. And the bit rate describes the accuracy with which we're going to capture our sound. Okay, there are codecs that are used to digitize sound, and the codecs, some of them are lossless. That means that you don't throw away any information, and some of them are lossy. That means that you throw away some information. When you throw away some information, the bitrate says how much information you're throwing away. From this perspective, eigenvalues and eigenvectors, what this means is that the bitrate tells us how many eigenvalues we keep and how many eigenvalues we throw away. Okay, the less eigenvalues we throw away, the higher the bitrate, and the better fidelity we get in the sound. If instead we take very low fidelity, then the eigenvalues that we keep are very few, and the music doesn't sound so nice. Today we're going to see the analogy of that when we create investment scenarios. Okay? And it's going to be very important to understand complex markets. Some markets will be very easy, like fixed income, and some will be very complicated. Okay? Like hedge funds. I'll explain this later. So let me ask a question and ask you if you already knew this. This has nothing to do with math or physics or investments. This is something that is part of your general culture, and I would like to know if you already knew that. Can you say yes or no if you already knew this? B knew that. Good. Other people knew that? If you knew this, it's easier for me to express the relationship between different markets, which is what I'm about to do now. So 2 people knew this, 3 people knew this. Good. So I can assume that everybody knew that. That's good. Okay, good. So then let me continue. Okay. Then any matrix can be decomposed into an orthogonal matrix, the inverse of the orthogonal matrix, and a diagonal matrix. And this is important for us because this is going to allow us a way to numerically work with matrices in high dimensions. When you put this into a computer, then this will allow us to do things in a certain way. Now, the diagonal matrix, which contains the eigenvalues, and the orthogonal matrix here, there is a way we can work with this from a computer perspective, and that is considering not ODO inverse, but considering what's called the Cholesky decomposition, which the formula is here. The Cholesky decomposition is a matrix which is upper triangular. It has zeros below the diagonal, and our matrix is a product of that matrix times its inverse, times its transpose. Times its transpose. Right? The Cholesky decomposition is the basis for a lot of the computational techniques we're going to be seeing today, which are used to work in spaces of very high dimensions. So when I have a Gaussian distribution like this one in a space of very high dimensions, when I take my variance covariance matrix and I find its Cholesky decomposition, then the following will happen. When I have a data set given by my variance covariance matrix, by my distribution, this modified by the Cholesky decomposition is a Gaussian, which is 0, 1. Okay? In other words, the Cholesky decomposition takes any Gaussian in any dimension to a Gaussian which is in 0, 1, uncorrelated marginals. Okay, so this is important because that means that the Cholesky decomposition plays a role of simplification. We saw last week and the week before that the cumulative distribution function sends a uniform distribution to any other distribution that we want. Today, here we see that the Cholesky decomposition sends any Gaussian to a Gaussian which is 0, 1, uncorrelated, and therefore simple. That's what the Cholesky matrix does. So this is very important, as you're about to see. Okay? I'll pass this, because this is the form that the Cholesky decomposition does. This is my general matrix, and this is the Cholesky decomposition and the transpose. And this is what I call a lower triangular matrix. Okay? There are zeros above the diagonal here, and there are zeros below the diagonal here. As you know, when you have a matrix which has zeros above or below the diagonal, these matrices are very easy to work with. Very easy to work with. Okay? And this is true for any matrix, any symmetric matrix. This is true for any covariance matrix. Okay. Moreover, I'll tell you, these are, I want to say easy to calculate. Easy to calculate. I'm going to say they're easy to calculate. Okay. And the property that I mentioned earlier, you can see here. I'm sorry, there's a lot of equations here, but if X is a certain Gaussian distribution, the Cholesky decomposition applied to it will have a different, we'll give it a different name, call it Y. So these are vectors, that's vector, that's a vector. And then because of this, this is the expression that appears on top of the exponential in the Gaussian. Then this becomes the product of the vector Y with itself. Therefore, look at this, this is what we're saying. My complicated Gaussian, this is complicated, because a simple Gaussian in a space where the components of Y are uncorrelated. Okay, so this is what the Cholesky decomposition does. The Cholesky decomposition sends something complicated to something easy. So if we have a certain data set here, we make a linear transformation of the data set. A linear transformation is important because it's also simple. We just multiply by a matrix. So a linear transformation of the data set results in uncorrelated marginals. A Gaussian with uncorrelated marginals. Okay? This has a generalization that you probably have also seen. I'll just mention it, but we're not going to use it, which is when you have it's called a singular value decomposition of a matrix. When you have a matrix, it doesn't have to be even symmetric or positive definite. You can do the following thing. You can take the matrix, multiply by a vector many times. You can iterate. This is an iteration. You can multiply the matrix many times by the same vector, and when you multiply that by the vector, this converges to the largest eigenvalue. And I want to make a comment about this. This is a comment that has to do with the assignment that you just finished. See, in the assignment you just finished, you were doing something similar to this. It was not a multiplication by a matrix, but you were doing an iteration. Okay? Remember? You were iterating. You were calculating some weights, modifying the weights, calculating derivatives, and you were doing that many times. This is called an iteration, what we call a fixed point process. So this is another fixed point process, just like in your assignment 11. Okay, I mentioned to you a few weeks ago that these fixed point processes are very common in investing, and well, here is another example. You can use these fixed point processes to calculate eigenvalues and eigenvectors. You may have seen also applications of fixed point processes, for example, to do rankings of websites. When you use a search engine in the web, the search engine will also use a fixed point to determine which websites are more popular. For example, so fixed point processes are really everywhere. And I want you to be aware and be proud that you have done your own fixed point process in assignment number 11 to find the weights of a risk parity portfolio. Okay, so this is relevant because it touches with what you did in assignment number 11. Okay, so in other words, this process that we have seen here tells us that with the Cholesky decomposition, we can always break down a Gaussian into its independent components. Now, let me give you an application of all of this, which is exactly the same thing that I told you about the music analogy that you already had seen before. I'm going to take here stocks. How many stocks am I taking here? I'm taking 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 stocks. And then I'm taking the variance covariance matrix. Okay, of these stocks. You've already done this. You did it for 3. Okay, here I did it for 10, but you could have done it for 3. And then I'm going to do the eigenvalues and eigenvectors of the variance covariance matrix of these 10 stocks. Watch what happens. Okay, I know there's a lot of numbers in front of you, but I want to walk you through the numbers that we have here. Please pay attention. This is important. This is the first eigenvalue, and this is the first eigenvector. I'll continue. This is the second eigenvalue, and this is the second eigenvector. I continue. This is the third eigenvalue. This is the third eigenvector. And I can continue. Fourth eigenvalue, fourth eigenvector. Sixth eigenvalue, sixth eigenvector. All the way to 10. Okay? Now let's look at this and think about it. Let's analyze it and think about it. These are equities, stocks, okay? So the first thing is, look at the first eigenvector. It's here. These are the components of each stock in the eigenvector that we have. What do you see here? Please look at all those numbers. There's 10 numbers there. What are these numbers? The remarkable thing is that these numbers are more or less the same. They are almost equal. We'll say they are equal with quotation marks. They are almost equal. This is important because it means that stocks are very similar to each other. And the first eigenvector is one that contains almost the same amount from each of the stocks that exist. And note one thing, when you look at the size of the eigenvector, the size, it's very hard to see what the size of this is, 2 point something, but look at what it says here below. If you look at what it says below, this is the percentage of the explained variance. This is the percentage of this eigenvector with respect to the entire size of all the eigenvectors. And that shows us that the first eigenvector accounts for half, 55%, half of the variance. So this eigenvector explains 50% of the movement of the stock market. This is what you call an index. Okay? If these stocks were from the Hong Kong exchange, this first eigenvalue will be very close to the Hang Seng index. So the Hang Seng index is an eigenvalue. Sorry, an eigenvector. If these stocks were stocks in United States, they will be very similar to the S&P 500. So the S&P 500 index is also an eigenvector. Stock indices are eigenvectors. That's something that I want you to be aware of. Very important. And they explain a lot of the movement that happens in the market. That's why when you listen to the news, to the financial news don't usually tell you the value of all the stocks, what they did today. It's too many. They tell you what the index did. Why is that significant? Well, that's significant because if the index did one thing, very likely all the stocks did something similar. This is the property that eigenvalues and eigenvectors have, especially the eigenvector with the largest eigenvalue, which is what the index is. Okay? So that's the eigenvector with the largest eigenvalue, the index. Now, how about the second one? What is it? What is the second one? Okay, in the case of, I'll explain. In the case of equities, we're going to see what happens in the case of bonds. But in the case of equities, the second eigenvalue and the second eigenvector are also indices. But they're different type of indices. For example, you may know there's a paper by, this is very advanced as I told you, okay? Now I'll have to refer to papers. There's a paper by Fama, Eugene Fama and French, where they explain that one of the driving factors for stocks is the large cap, small cap difference. That means stocks which have a large capitalization and stocks which are low capitalization, or in other words, big stocks, big companies and the small companies, they move differently. Okay? Well, this second eigenvector is something like that. It's the differential between big stocks and small stocks. Okay, so these are now risk factors which have decreasing relevance when you try to understand the market dynamics, in this case the stock market dynamics. Okay? And because of that, and these are very hard to explain, these are hard to explain. And their contribution is much lower. They contribute 1%, 2%, 3% of the entire movement in the stock market. So that means, this is the important thing, that means that if you want to understand the stock market at a certain high level, this is what you do. You stay there. This will give you most of the information about the market at a very high level. But if you want to start understanding differences between companies, like for example our long A short B example of a month ago, if you want to understand this type of differential, this understanding of the job market, of the stock market is not enough. If you want to understand that aspect of the market where you can profit from differences between stocks, then you have to go to the second eigenvalue or beyond. Okay. We also expressed this in a different language some time ago, and I'm going to introduce that now to you. This is what we call the beta of the market. Okay, that's the market beta. The alpha are the difference between the different eigenvectors. Okay, remember we saw the alphas and the betas a long time ago, we saw linear regression. It all comes down to this. This is what's called the spectral analysis of the market. And the spectral analysis of the market helps us understand what the alphas and the betas are. Okay? So if you're going to be an investor, which is a stock investor, and you're just going to buy stocks long, very likely you're going to invest in the first eigenvalue here. But if you're an investor that wants to take advantage of stocks, you want to take some stocks long, some stocks short, then you have to get into these other eigenvalue considerations. That's number one. Number two is, imagine that you want to do something different now. You want to generate future values for the stocks. How do you do that? I'll give you an example. I'll go back to an example where this was important, okay? It was here. Remember this? Here we took one scenario for A and B. Imagine we want to do more. Imagine that instead of 2 stocks, we have 10 stocks. How do we generate future scenarios for 10 stocks? How do we do that? Okay, here, how do we do that? We have this variance covariance matrix, we have the eigenvalues and eigenvectors. Therefore, this matrix, we can diagonalize this matrix, like we saw here. We can diagonalize this matrix like that. These lambdas are the eigenvalues. And generating scenarios here is very easy. We saw that the Cholesky decomposition sent us to normal distributions which are uncorrelated. So you generate each of these independently, and then you put them together with our orthogonal matrix O. Okay? Or with our Cholesky decomposition. That's how you do it. We saw it earlier. So this is the information that you need to do that. So you're going to put this matrix into a computer. You're going to find the Cholesky decomposition. Okay, this has a Cholesky decomposition. You generate Gaussians which are normal 0, 1, and you multiply the Cholesky decomposition by those. That's how you generate future values for the stocks. And that's how you can do scenario analysis for the stocks in the future. This is how you generate future history. Okay? Building the future. That's what we're doing. We're building the future. This information is what you use to build the future. Yeah? All right. Let me no, I'm going to pass this. This is too sophisticated. Let me explain this now. This is what we just saw for equities is this line here. This is what we just saw for equities. And you see here how the eigenvalues decrease and they go down. You see? This is what we just saw for equities. What is this telling us? This is telling us that stocks have an index which has a lot of weight that represents a large portion of the movement of all the stocks with each other. And then beyond the index, there's very little. This is very small. Okay, let me now take a different market. I'm going to take the market of hedge funds. Remember what hedge funds were? Hedge funds were those trading strategies that you go long and you go short. Convertible arbitrage, equity long short. When you do those, look what happens. I'm going to put it in different color. I'm going to put it in green. When you do those, look what happens. The first eigenvector is not so strong. And these are not, so this is not so big, and these are not so small. Why is that? That is because they are more diverse. Because they go long and they go short, they remove the beta from their trading, and then it takes more eigenvalues to capture that market. Okay, so these are more diverse. Equities are more concentrated. So these tell you investment behavior. If you're going to be investing in stocks, most of the performance you get comes from here. You don't have to be very careful, okay? And this contains a lot of noise, if I use my analogy with music. But if you're going to be an investor that's going to go long and short, you're going to buy stocks, but you're going to short stocks. You're going to go long and short. Then you're going to end up with a distribution which is different. You're going to have a much more diverse type of investment. Okay, so, all right. I'll continue this. And the connection with music is, we saw this earlier, okay? When n equals 1, that will be the stock index, which in music is called the fundamental frequency. Okay. When you apply this in fixed income, the eigenvalues and eigenvectors have a different meaning. The first eigenvalue, or the first eigenvector, is when you look at the way the yield curve moves. The first is the parallel movement of the yield curve. That is the first risk factor, the one that carries most of the information from the market. The second one is when the yield curve moves up and down and it tilts up and down. The third one is when the yield curve does what's called the butterfly spread, when it changes convexity. That's the third one. Okay, and then beyond that, there is almost nothing. So fixed income markets can also be explained with eigenvalues and eigenvectors. Okay, the fundamental frequency is the movement up and down. The second frequency is tilting of the yield curve, which happens, for example, when you go from recession into growth, or from growth into recession, or inflation, for example. It makes the yield curve tilt. And the butterfly spread is the change of convexity, which happens in the market, but it has less dominance than the first and the second eigenvalue. So you see, you can always understand markets by looking at the eigenvalues, just like you understand music by looking at the fundamental frequencies. So the MP3 technology applied to financial markets is what we saw today. Okay. All right. Well, let me just continue. It's an interesting observation about music, but you told me already, so that maybe you already know. All right, so let me now move away from Gaussians. Okay, we're moving now away from Gaussians. And when we move away from Gaussians, then we lose the matrix structure, because the covariance matrix no longer describes the dependent structure. So when I move away from Gaussians, I have to have other ways of expressing the dependence between the marginal distributions. Okay? And I'm going to do it the same way we did it last week when we were looking at one-dimensional, which is through Sklar's theorem and the way we map uniform to generic distributions. So I'll make one comment. if the marginal distributions are uniformly distributed, okay, if they are uniformly distributed, then the cumulative distribution function, I think this is defined there, okay, is a function, is a map that goes from the unit cube in n dimensions, n is the dimensionality of our problem, into the interval 0, 1. So this is the cumulative distribution function for uniformly distributed numbers. Okay, so what used to be a matrix that expressed the dependence between numbers, the matrix is now replaced by a function. The matrix only works for Gaussian distributions. For non-Gaussian distributions, you need a different system, and this system is based on a function. This function has a name, it's called a copula. That's the name, because it tells us how things are related to each other. Okay, now, but this is the copula for uniform distributions, the things that any other distribution also has a copula, and I'm going to define it for you now. Okay, if I take any distribution of any type, we already saw that we can map each of the marginal distributions into a uniform distribution by taking the inverse of the cumulative distribution functions. We already saw that. Okay, these are marginally uniform distributed. We saw this 2 weeks ago. So these are marginally distributed. How about the dependent structure? What is it? A copula. Okay, so the copula corresponding to this uniformly distributed function or variables is the copula for our distribution. This is important because this allows us to define the dependent structure for groups of variables which are not homogeneous. Okay, if you're dealing with a Gaussian, we already know what to do. We saw that through the beginning of today's class. But if you're dealing with variables that are not Gaussian, and the correlation is no longer enough to specify their distribution, what we do is we use the copula. And the copula is defined like this: is the function that maps the unit cube into the unit interval in high dimensions, corresponding to the distribution with uniform marginals given by these. Now, this is very advanced, very, very advanced, but this is something which is perhaps the most advanced topics in the entire course. I still want to bring it to your attention so that you know that this is how you monitor the dependent structure between variables which are inhomogeneous. Okay, and there's many types of copulas which are parametric copulas. Okay, in practice, you don't work with the unparametric or with the unconstrained copula. You want to introduce a model, and there are two types of models for copulas. One of them are explicit, they have explicit functions, and others are not explicit, but they're very well understood. For example, the Gaussian copula. The Gaussian copula is not explicit, but is very common. And the explicit ones, there's different types: Campbell, Clayton, Frank. It doesn't matter. I'm not going to spend time with this. I just want you to know that there is something called the copula. The Campbell is, for example, used to understand tail dependency. This is something very important. Sometimes you have financial variables who depend on each other in certain way, but when something bad happens, the dependence changes. For example, during times of financial crisis, sometimes variables behave differently. Their dependent structure behaves differently than during normal times. So the Campbell distribution is one which allows to understand these types of things. The Clayton one was designed to understand downside correlation. Okay, so whereas the Campbell is good for very good or very bad markets, this one, the Clayton, is designed for very bad markets only. and so on and so forth. Okay, so this is how in investments you take the dependent structure and you make it free from the assumptions of Gaussianity. Gaussianity, as we saw 3 weeks ago, give us a lot of restrictions. Excuse me. Give us a lot of restrictions as to what the markets can do. Through the use of copulas, we can use a much more realistic model for how the variables in a market work. And in particular, through copulas, we can also bring the dependence between random variables which are of inhomogeneous types. Like, for example, we can have the default probability as a random, as a risk factor, and snow or no snow as another risk factor, and we can figure out ways in which these things are correlated. The copulas allow us to do that too, and they bypass the simple concept of the correlation functions. Okay, so this is all the content I had for you. I'm going to end my presentation here. And now, are there any questions?